Hello and welcome to Bytesize Newscast number 16. In today's episode, we are answering the age-old question, how do I maximize my returns and how do I time the market perfectly? Now, in order to do so, we're going to be looking at charts, data, and models. Now, using these models, we're going to identify Bitcoin and crypto's potential. What is the potential in this asset class? Now, on top of that, we'll be looking at Bitcoin and crypto as an investment strategy in terms of long-term, medium-term, and short-term investment strategies. Now, when we put this all together, we're going to answer the question of how do I time the market perfectly? How do I find that sweet spot that helps me return the most amount of money over a specific time frame? Now, I guarantee you 100% that you haven't heard this piece of information before. So I'm very excited. If you like this content, please subscribe, like, or leave a comment down below. Anyways, let's get down to business. Let's get started. To start us off on our journey, I think it's important to come to grips with why models and graphs and data is so important. First and foremost, it'll help you prove a particular investment idea. Let's say you have an investment idea and you want to visually prove it using data. Then a model or a graph is an incredibly effective method to do so. And I'll show you in a minute as to why. A good model or graph also generates discussion. Perhaps there is multiple points of view you can have on a similar chart. It'll help you make predictions by seeing how trends evolved in the past. You can make a prediction about the future. It's a visual representation. Humans are very visually representative. So if you see something happen visually, it's a very good way to come to grips with what's happening. And on top of that, it helps you develop a mental model. And developing a mental model is incredibly important for an investor. Now, as I mentioned before, a graph can be a very good tool to help you visualize or help you understand something that you feel has been going on in the market or the wider macroeconomic space over the last 10, 15 years, for example. Now, for me personally, I felt that over the last 10, 15 years, I've been getting prospectively poorer. And it doesn't have to do anything with the fact that I earn less, but I just feel like things have been getting more expensive. Now, what this chart represents is the price growth of particular goods, services, and investments over the last, 33 years? No, 43 years. And as you can see, the red line here represents the median US household. That's the median income a US household generates, so the average person, let's just say. And as you can see, this red line has outperformed some lines and underperformed others. They all started equal. And what you can see, the outperformers here are gold, the S&P 500, crude oil, even copper. And what that tells you is that investment products, these are all investment products, gold is an investment product, the S&P 500, which are stocks, is an investment product. So investment products have been getting more expensive over years. And on top of that, the amount of debt, so that's the white line seen here, has also grown exponentially. And we all know that debt is something that pulls you down. Now, the things we've outperformed are the CPI, which are this is the Consumer Price Index, which is a basket of consumer goods. That's gotten cheaper. Live cattle, so meat's gotten cheaper. And what this basically tells you is that investment products are getting more expensive and consumer products are getting cheaper. And what that tells you is the fact that as a consumer or as an investor, your respective opportunities have been getting bigger or smaller. And with the growth of the price of investment products, becoming an investor belonging to the investor class, where you generate most money, has become increasingly more difficult. Whereas belonging to the consumer class, spending money, giving to the investors indirectly, has become easier. It's been facilitated. So there's a divergence, judging by this chart, there's a divergence between the investor class and the consumer class. And I find this to be very, very interesting. Now, what that conclusion looks like in another graph is represented here. And this is the average amount of stocks, S&P 500 stocks, the US median household can buy. And as you can see here, between 1974 and 1980, that was about 40K, hovering between 40 and 30K. That has dropped down to just over 5K, right? That is a decrease of 87.5%. That's a big, big number. And personally, I think that's why crypto has become so interesting, because it's one of the few opportunities that the regular investors, the day-to-day investors, the small people have had to beat the big institutional money to a particular new asset class. A short recap on the importance of charts. Now, charts help us get an understanding of current events. It demonstrates where we started and where we are now, and it shows a particular trajectory, for example. Now, on top of that, it helps you generate a more nuanced view. It helps you generate insights. Let's say I have a very specific, very extreme view about something, but then a chart proves otherwise, then maybe I'll have a more nuanced view. And it also helps you, if you have a particular feeling about something, it helps you find the facts in the feelings. So once again, charts are very important as a tool to help you understand the world around you. Now, the cool thing about understanding the past and the present is that you can see a particular trajectory that something's on. Now, if you understand the trajectory something's on, you can make a prediction about the future. And that's exactly what ARK Invest has done here down below. Now, as you can see, they've taken the compound returns on Bitcoin over the last 6, 7, 8 years and used that statistic to tell us something about the future. Now, by their prediction, they think or they know that Bitcoin was about 220 million at the start of 2020, and they predict that that same market cap will rise to 3 trillion by 2025. These are lavish, very big predictions, and it also demonstrates why you should always take future predictions with a grain of salt. We don't know what the future looks like, right? Maybe Bitcoin will be made illegal by 2025 and the market cap will be much lower. Maybe it'll be much bigger. We just don't know. So always remember that these future prediction charts should be taken with a grain of salt. We don't know what the future looks like, and the only reason why we use these charts is to get an understanding of how things could potentially develop. Now we're getting into the truly nitty-gritty of graphs and the intersection between investing. Now we all know that building a diversified portfolio is an important way to maximize your profits over a longer period of time and generate lower risk to the downside. But what is diversification? If you buy a Volkswagen stock and a Apple stock, is that a form of diversification? Are you diversifying? Well, the way to find that out is by correlation. Now, correlation means when something reacts, does the other thing react? For example, if the price of a Tesla stock goes up or down, does that influence the Mona Lisa, the art piece? No. So the correlation between these two is very low. If the price of Bitcoin goes up, does the price of Ethereum go up? Probably. So the correlation between these two assets is very high. Now, if you want to buy or you want to build a diversified portfolio, what you want to do is you want to have as many assets in there that have a low correlation with one another. Now, as these charts will demonstrate, Bitcoin has a notoriously low correlation with other assets, which underlines why it's important to have Bitcoin in your investment portfolio. Now, another reason why I wanted to point out correlation is because conceptually, correlation can be a little tricky to wrap your head around. And it's also, for some people, one chart works better than another. And I think correlation is a very good way to demonstrate that. So what I've done here is I've taken 3 correlation charts, which tells you the same kind of information, but visually represented in another method. Now, this is the first one. This is the bar charts. So if you're into bar charts, this one works really well for you. And another one is a line chart. And the interesting thing that you can really identify here is the fact that correlation differs over time. And as you can see at the end of 2020, you have this big, massive spike in correlation. And what that tells you is when the COVID shock happened earlier in 2020, all the markets went down, Bitcoin went down as well, which tells you that Bitcoin is not a safe haven from market shocks, right? And finally, an interesting one is the correlations chart, which tells you very specifically in numbers. So if you're number oriented and also color oriented, then this is a very good way to understand correlation between one or two assets. So a final short recap before we get into the really interesting stuff. Um, Charts and graphs can help investors understand theories and ideas they have. They can help us understand how a particular historic trajectory has developed and help you make a prediction about where the future could potentially go. Now, they also help us make sense of how two or three things relate to each other through correlation, for example. And an important thing to keep in mind is that not every chart works for every person. So if you're line oriented, bar oriented, or you have a particular way you want your information presented to you, you're a unique individual. So find the charts that work for you. Now, one of the most important, if not the most important thing to take into perspective as an investor is your time horizon. Now, for most investors, a longer time horizon, 5+ years, is advantageous because it allows your initial purchase of a particular asset to accumulate in price over time. Now, a long-term investor typically looks at an asset over 5+ years. And what's important to take into perspective then is that you want to have charts and data that take this longer term time horizon into perspective. And the key reason as to why you do this is so you don't get distracted by day-to-day fluctuations in price and you don't find yourself looking at the price of your asset on a day-to-day basis. You can invest in it and then technically you can forget about it for a longer period of time. Now, one of the reasons why we want to take charts that take a longer term perspective into consideration is because it allows us to compare it to other things that have developed over a longer period of time. Now, the chart I have up here is one of those charts, and I'm going to put it up on the big screen so we can have a look at it in detail. Now, the thing I was talking about earlier is the internet. And the chart here I want to demonstrate to you guys is made possible by Willy Woo. I know his name is kind of silly, but his charts are amazing. Is on adoption curves. And you can see three main sources of information on this chart. The first one I want to point out to you guys is this is the adoption curve in the green of Bitcoin, and you can see that the adoption curve of Bitcoin is followed by this squiggly line, and this squiggly line is the price. Now this underlines the thesis that the more Bitcoin users there are, the higher the price, and that makes sense. If more people want to use the network, more Bitcoin is required, and thus the price increases. Now, the second source of information that you can see on this chart are adoption curves. Now, on the left here, you can see the adoption curve of the internet, and on the right, you can see the adoption curve of Bitcoin. Now, you can see one thing really quickly, and that is that the adoption curve of Bitcoin is quite a lot steeper than the internet, which demonstrates that Bitcoin is rising in popularity quicker than the internet. Now let's follow the trajectory of the internet for a second. In 1997, the internet had 120 million users. Now it took the internet from 1997 all the way to 2005 to grow to 1 billion users. Now if we follow the trajectory of Bitcoin, we can see that even though it slopes down a little bit because it's taking a cautious approach, we can see that in the next 4 years, so January 2021, we had 135 million Bitcoin users. By 2025, following this trajectory curve, we can expect to see 1 billion users in Bitcoin. Now, if we have 1 billion active users in Bitcoin, we can expect the price to follow suit. So once again, looking at these grander scheme charts, and getting a longer term perspective by contrasting a particular emerging technology to another emerging technology or a technology that had emerged over time, you can really get a sense of the potential that your investment, in this case Bitcoin, has over a longer period of time. Now, as a long-term investor, it's very important to understand what the macro environment is doing. And what I mean with macro environment, I mean the wider economic space. So the macroeconomic space, which is the economy as a whole, and not only a country, but the whole economy. Now, because we're dealing with a big space, the important players in this big space are central banks. More specifically, are central banks printing money, so causing inflation, or trying to create inflation, or are they taking money out of the economy? Now, it's very important to understand what is happening in this perspective because every single asset that you invest in has a different relation to the macroeconomic environment. Now, for Bitcoin, inflation is quite good. And so a environment in which central banks are printing money is a very good and very fruitful environment for Bitcoin. Now, the relation of Bitcoin to inflation is described pretty accurately in the Mazzari report, Crypto Thesis for 2021. Now, this report, even though it's 134 pages, is written in such a way that everyone can understand it. It's kind of a tongue-in-cheek kind of way, and it goes over some of the most important topics that are going on in the Bitcoin and Ethereum and crypto wider macroeconomic space. Now, for us, the important stuff happens on page 9. And you can see here, this is the explosion of central bank balance sheet. And what that basically demonstrates is the amount of money being put into the economy. And as you can see here, that has dramatically increased in the last year, which tells us somewhere down the line, we're getting a lot of inflation. Now, on top of that, we have negative yielding debt at an all-time high. Now, negative yielding debt, that's kind of an interesting concept because you take out a loan and you get paid for it. That's kind of an odd concept, but it seems to be the place where the economy is going right now. And it turns out that Bitcoin is a very, very good hedge against this scenario. And that has to do with the fact that we know there's only going to be 21 million Bitcoin, right? There's a limited amount of Bitcoin in the world. And if there's a seemingly infinite amount of money in the world chasing after a limited amount of a good, then that good will rise in price. So this demonstrates that A, Bitcoin is a very good hedge against inflation, and B, understanding that this inflation is going on in the wider macroeconomic space underlines the thesis that Bitcoin is a very good place to be as a long-term investor. Now, up until this point, the focus of this video has pretty much been on Bitcoin as an investment thesis, especially for long-term investing. But I want to give a little shout out to Ethereum because a lot of people prefer Ethereum over Bitcoin as a long-term investment, not only for what the protocol can do, but more predominantly because you can put your Ethereum to work. You can stake your Ethereum. Now, what staking is, I'll go over in a later video, but for now, what you can take away from it is when you stake your Ethereum, you're putting it to work. You're putting it to work to make sure the network works according to how it's supposed to, and in return, you get a small amount of interest paid in Ethereum. Now, as you can imagine, this is a very, very interesting proposition for someone with a long-term time horizon because it allows your asset not only to grow in value, but to grow in size as well. Now, as a long-term investor in Ethereum, and you want to stake your Ethereum, there's one important metric to take into consideration. It's described here on page 51 of the Mazzari report, but I'll go over it with you guys real quick. And as you can see here, the more Ethereum that is staked, so this is the staked Ethereum in millions, the lower the expected returns are. And that has to do with the simple fact that you have to share the reward with more people. Now, what this looks like in detail is described here. For example, if 1 million Ethereum are being staked, then the return is about 18%, which is a big number. And if that increases to about 10 million, the expected return is about 5.7%. So you may wonder, how do I figure out how many Ethereum are being staked? Well, it's quite simple, but you have to kind of know it. You have to visit the contract address. That's quite a chunky address, so I put the link to this address in the description below. But the important metric here is the balance. Now, the balance represents the total number of Ethereum being staked. And as it stands, that's just over 3.3 million. Now, if we use this 3.3 million and cross it over with the Messari report, we kind of have a 10% annual return on your staked Ethereum. That's quite interesting. But you can expect this number to drop because a lot of people are seeing this 10% interest rate on Ethereum and thinking, ah, that's quite interesting. To help you understand what the expected returns on your staking might be, it's important to understand the trajectory. Now, I found this very interesting chart on CryptoQuant, and it's the total value of Ethereum staked, total value or total number of Ethereum staked. And it shows two metrics. The red line being the total number or value of Ethereum staked, and the black line being the price. Now, what's very interesting to see here is that the total value or total number of Ethereum staked is not increasing exponentially. So when you're staking your Ethereum, you don't have to expect that your 10% annual return will drop down to 3% in a matter of weeks or months, maybe even years. Instead, you'll see the interest curve down very, very slowly. Now, the second thing that's very interesting about this chart is the price. And as you can see here, when the price increases, the slope or the amount of ether being staked decreases. And that's very simple. This has to do with the fact that it takes more money to buy Ethereum. And if you have to spend more money to buy Ethereum, it means you have less capabilities of staking Ethereum. So for an ETH staker, you can expect two things. First of all, as the price of Ethereum increases, the amount at which your interest rate decreases slows down. And the second thing is, you don't have to be afraid that your interest rates will dissipate over a matter of weeks, months, maybe even years. Instead, you'll see it slowly decrease over time. So if that interest rate gets to a point where it's no longer interesting for you, you have plenty of time to take your ETH out of the staking. Returning to Bitcoin and long-term investing in Bitcoin. One of the most compelling charts for long-term investing in Bitcoin is the stock to flow model by Plan B. Now, Plan B is a investment banker who took an interest in Bitcoin. Now, the stock to flow model basically describes the amount that is in stock divided by the amount of flow. Now, what they mean with stock is the amount in circulation. So, for example, the amount of gold that is currently in circulation divided by the flow, which is the amount of gold being mined. Now, if you take the stock divided by the flow, you get a stock to flow ratio. Now, a stock to flow ratio can be used for gold, it can be used for silver, it can be used for housing, and it can also be used for Bitcoin. Now, the stock to flow model is a proven model. As you can see here, the stock to flow of gold is about 62. And as you can see, the market value of gold is pretty darn big. Now, the stock to flow model of silver is much lower, and you can see that reflected in the market value. And similar for palladium, stock to flow is 1.1, and you can see it reflected in the market value. Now, the way the stock to flow model works for Bitcoin is as follows. Here you can see a white line. Now, this white line is kind of like steps. And the reason it's like steps is because every 4 years, as you can see here, every 4 years, the amount of Bitcoin that gets issued gets cut in half. This is called the halving cycle. And the colored line, the colored dotted line, is what the price of Bitcoin is. And as you can see, the price of Bitcoin follows that stock to flow model very, very closely over years. And when it's above the stock to flow model, it rebalances down, or when it's below the stock to flow model, it balances up. So if you're a long-term investor and you're looking for a particular moment in time to allocate your capital to Bitcoin, the stock to flow model is a very, very good model to tell you if in a long-term perspective, the price you're paying for Bitcoin is overpriced or underpriced. That's a lot of information to take in. So let's just do a short recap. First of all, as a long-term investor, you want to have charts and sources of data that reflect this long-term time horizon. You don't want to be caught up looking at the day-to-day price movements of Bitcoin and having your emotions take the hold of you. You want to reflect on the long-term potential of your asset. Now, on top of that, you want to compare crypto or Bitcoin to other emerging technologies and see what kind of growth trajectory you're expecting. Now, also, the macro environment is incredibly important. Bitcoin has been historically proven to do well during inflationary environments and do less well during deflationary environments. Now, if you're an Ethereum investor, you want to keep an eye out on staking rewards because they may influence the amount of Ethereum you're expecting to generate over a longer period of time. And finally, if you want to get a little bit sense of timing, have a look at Plan B's stock to flow model. It'll give you a good sense of when good buying opportunities are in the relatively near term. Moving on, we have arrived at medium-term investors. These are investors that have a shorter time horizon, perhaps 1 to 4 years. Now, as a medium-term investor, one of the most important metrics is the halving cycle. I mentioned these halving cycles before, but just to reiterate, every 4 years, the amount of Bitcoin issued is cut in half. This means the inflation of Bitcoin is also cut in half. And you can clearly see that on this line right here. Now, this is quite dramatic, so we'll ignore that for now. But starting in 2011, mining was pretty sophisticated and the inflation rate starts to become dependable. And you can see here in 2013, when the first halving cycle happened, there's an immediate response from the market. Similar in 2016, there's a response to the market, and then in 2020, there's once again a response to the market. So if you want to time your medium-term time horizon investment opportunity, you want to take into consideration when a halving cycle has happened. So for example, most of the time, about 2 years after the halving cycle, there's a retraction. So we've just had a halving cycle. So we can expect that maybe by 2022, maybe 2023, for a medium-term investor, you can find a very good buying opportunity. Now, as a medium-term investor, it can be interesting to look outside of the parameters of Bitcoin and Ethereum. And if you're interested in this kind of thing, one of the things you must look at is the amount of active developers on a network. See, the amount of active developers determines the amount of cool new stuff that gets produced on the network. So for example, here we have, this is by Electric Capital, and you can see they monitor the amount of developers on a network. And as you can see, Ethereum is the clear number one without a doubt. But here you can see in the purple, I think it's purple, very clearly that Polkadot is on a very, very positive trajectory. Now, this also points out that Cosmos is a active competitor, but I would kind of suggest that if you look at this kind of active development stuff, you look at trajectory. And here you can see once again, Polkadot is on a very clear trajectory upwards, and Cosmos is kind of teetering around the same place. So there's not really more adoption, whereas Polkadot definitely has more adoption. So just to reiterate, as a medium-term investor, keep an eye out on the amount of developers on the network. And if you find one that has an increasing amount of developers, it may be an interesting short-term or medium-term investment opportunity. Now, one little caveat I want to point out to this whole active developers thing is that these numbers are based on GitHub. Now, I come from a data science background, and let me tell you something, it is very easy to make it appear as if there's a lot of activity going on. You just make teeny tiny changes in the code on GitHub, and it shows up as activity. Now, what you want to do is you want to go to the GitHub. Let's take Ethereum, for example. And you want to go to the repositories, click on one, and then check out the issues. The number of issues is a good indication, but also the quality of the issues. So let's just take a random one, and you see, I got lucky on this one, that there's a lot of information and a lot of engagement surrounding these issues. Now, if you go to a GitHub of your respective project that you're trying to figure out, and you see there's barely any issues, and the issues that they have posted are poorly written, or there's not much engagement on it, you can kind of go with the flow and suggest that there's some shenanigans going on that GitHub. So keep an eye out on that one. It's a very important little extra metric to keep an eye out for if you're tracking the active developers. There's two more metrics I want to share with you guys. The first one being the amount of crypto on exchanges, and the second one being miner outflow. Now, in terms of crypto on exchanges, the amount of crypto on exchanges, okay, the volume of crypto on exchanges, demonstrates the amount of people looking to sell their crypto. If there's a lot of crypto on exchanges, a lot of people are looking to trade or sell. So when this number, this volume of crypto on exchanges is increasing, you're dealing with a sell-off phase. More and more people are looking to sell their crypto. On the other hand, if the amount of crypto on exchanges is shrinking, you're dealing with a buying or accumulation phase. So let's backtest that theory real quick. On this chart here, you can see in the red, this is the amount of crypto on exchanges. And in black, you can see the price. Now, as the price remains relatively stable, at this price, it's very interesting to buy and accumulate Bitcoin. Now, at some stage, the price becomes significantly interesting to move your crypto back onto exchanges, and we can see that happening here. So what you can identify as a short-term trader is when that trajectory from accumulation phase turns flat at some stage, we have the start of a selling phase. Now, a selling phase looks like this. The price of Bitcoin increases and people want to move their Bitcoin onto exchanges and sell it. Now, this selling phase goes on for a while, and then at some stage, the price drops so low that people no longer wish to sell it. Instead, they're looking to accumulate once more, right? We see that flattening of the curve and then moving downwards, which demonstrates that if you're a medium-term investor looking for an excellent buying opportunity, identify when the selling phase is over, when that flattening out of the curve happens, because that's when you get your best price action. Now, the final metric that's important for a medium-term investor is the miner outflow. Now, miners are economic actors. They mine Bitcoin and then they sell it at a potential profit in order to keep the lights on. So they're there to maximize their profit. And what that means is when the price is high, they want to sell the most. And the result of that is when the price is high, you get these spikes up and down, which makes it very difficult to time the market. In a sense, when the price is highest, the market is the most volatile and the most frothy because miners are the ones looking to sell. Now, what this looks like is as follows. You can clearly see here, every time there's a spike in mining pressure, in selling pressure even, you can see there's moments where the price goes down. So this is not my favorite metric, but it's one you have to consider as a medium-term investor. Consider the mining selling pressure and keep a close eye out on what miners are doing to influence the price of Bitcoin and other crypto assets. Now, a short recap for medium-term investors. The first thing you want to do is time your entry to the market according to the halving cycles. Just after the halving cycle, you can expect the market price to go up, and about 2 years after the halving cycle, you expect the price to be relatively stable. So time your entry points according to those moments. Now, the second thing you want to consider is you may be interested in looking outside of the standard Ethereum and Bitcoin narrative. If you want to do so, have a look at the number of active developers, but keep a close eye out for GitHub shenanigans. Now, another entry point or exit point you want to consider is the amount of crypto on exchanges. Is this number growing? Is it shrinking? Or is it stable? And what kind of trajectory change did it come from? Now, finally, not my favorite, but an important metric nonetheless, miner outflow. Miners are great sellers of cryptocurrencies, so if the miner selling pressure is high, you may want to stay out of the market for now or join them in their selling pressure. Now, for short-term traders, I don't have a lot of advice, and that has to do with the fact that trading is a different ball game than investing. The three things that I can give you, though, are first, trade when the mania is biggest, strike when the iron is hot. That has to do with the fact that the trend is in your favor. When a lot of people are looking to accumulate their crypto, the trend is upwards. And if you're trading, if you're going long during an upward trend, the odds are in your favor. And finally, there's going to be some 15 to 30% contractions during these upwards trends. Now, if you can time the bottom of these contractions, there's potential to be making a lot of money in the short term, especially if you're leveraged. Now, we've come to the end of the episode where I teach you guys how to time the market perfectly. Now, in order to do so, we need one more metric, and that is the NVT ratio. Now, NVT stands for network value divided by transaction volume. And without going into too much detail, the way you can understand it is if the network value, so the value of Bitcoin is very high, but the transaction volume is very low, the ratio is very big. And that means the network is overpriced. Let's say the price of Bitcoin is lower and the amount of transactions is higher, the ratio is smaller, so the network is undervalued or underpriced. So here we have Willy Woo's NVT price. Now the purple is the ratio, and you can see that when the ratio drops below this line, there's generally very good buying opportunities. Now judging by this chart, there's a couple of buying opportunities. Now remember these. We have them in July 2017, we have them in January 2018, January 2019, and what is this? March 2020. So these are very good buying opportunities according to this chart. Remember these buying opportunities, they'll come back in a minute. So remember Plan B's model, Plan B's stock to flow model. It also, similar to NVT, demonstrated when good buying opportunities are. Now what you will find is that when both of these charts, both the stock to flow model and the NVT chart demonstrate that there's good buying opportunities, that's the sweet spot. That's when you want to be buying your crypto and your Bitcoin for the best possible timing. And let me demonstrate that to you. Start of 2018, bad moment according to Plan B. However, it's a good moment according to NVT. So they don't correlate. They're not the same. They're not matching. That's not good. That's not when you want to be in the chart or when you want to be in crypto. However, at the start of 2019, stock to flow, very good buying opportunity. Start of 2019. Start of 2019, very low NVT. Very good moment to buy. Now, very similar, start of 2020, just before the stock to flow model demonstrates that the price is going to go up. NVT, same thing, very good moment to buy. So what I'm telling you here is that if you combine the stock to flow model with the NVT model, and when they both tell you it's a buying moment, that's when you need to strike. That's when the purchase of Bitcoin is in a sweet spot. And that's where you want to expose yourself to as much crypto as you possibly can. Not financial advice, just education. So there we have it, folks. Perfect timing. According to data, it exists and it can make you very prosperous. Now, in order to do it, you need to be very patient. Opportunities are very few and far between. And if you want to do it, combine the NVT premium with the stock to flow for an excellent measure of success. Now remember that data-driven buying will help you make better decisions. Don't let your emotions take control of you. Stay smart and stay data-driven. That concludes episode 16 of Bytesize Finance. This was a true epic joy to make. It was a lot of work, so I hope you enjoyed it. Now, in conclusion, remember, if you're interested in investing, think about your time horizon. It can impact which chart you look at. Don't be distracted if you have a long-term time horizon by the daily changes in prices, for example. And if you do identify unique opportunities, don't be afraid to act. Now, if you find this kind of information exciting, there's so much of it out there, so highly recommend you checking out some of these sources I linked here. Now, once again, I want to thank you so much for watching. If you like the content, please subscribe. If you have any questions or you want to get in touch or you have a request as to what kind of content you would like to see afterwards, please send me a message or leave a comment down below. That's it for today, guys. Thank you so much for watching. Bye!